The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. A low-volume day ahead of the big Fed dance tomorrow. Let's take a quick check on markets. The S&P 500 just about flat off of session highs. The Russell 2000, your small caps, outperforming today, up 0.5%. That index trading at an all-time high. The bond market, that sell-off continuing to a lesser degree. 10-year Treasury yields up about 2 basis points. And Bitcoin finding its feet, higher by about 2.6%, Romaine.
Meanwhile, you go back to the broad market, and definitely a bit of a holding pattern right now for investors as Wall Street waits for two key events that will define the sustainability of the bull market in U.S. stocks. What the Fed telegraphs tomorrow about the direction of interest rates, and what earnings reports from Oracle, Broadcom, and Adobe this week say about the pace of AI adoption. While mega-cap tech stocks are out in front on a year-to-date basis, they've been laggards now for the past 5 weeks. But don't mistake that slump as the end of the AI trade. In fact, all the talk of the end being nigh, it obscures a more thoughtful rotation going on underneath the hood. Taking profits from the massive gains in NVIDIA, Intel, and other picks and shovels AI names, and investing into the companies that stand to benefit from the use of those AI tools, whether it's in healthcare, manufacturing, financial services, and even in business consulting. And that actually leads us to one of the big news stories of the day. It involves Accenture and Anthropic inking a multi-year partnership deal to drive enterprise AI adoption. The two, they're going to form the Accenture Anthropic Business Group with the goal of training around 30,000 professionals in leveraging AI as a catalyst for reinvention. Pleased to say joining us right now is the CEO of Accenture, Julie Sweet, and the CEO of Anthropic, Dario Amodei. Great to have both of you here. And Julie, I'll start with you, mainly because when I saw this, I thought, wow, this is neat. Then I also thought about the fact that just last week, you announced a further expansion of your partnership with OpenAI. Talk a little bit about how these two coexist under the Accenture umbrella.
Sure. So all of our partnerships start with client demand. So the partnerships are responding to client demand. And we have a long history. Our clients expect us to be the #1 partner for every technology company that matters. And Anthropic, this partnership that we've announced today, is very important to our clients. And so that's the role we play, is to make sure that we can take the world's best technology and mix it up with industry knowledge, with process, and how to actually use it in the enterprise to get to an outcome. And as you know, today, it's all about when is AI showing up in the P&L. We call that the P&L pivot, and this partnership will help our clients make that pivot.
Well, I am curious then, Dario, if you can kind of talk about specifically the Anthropic tools, the idea here of standardizing how some of these AI agents actually connect to the various tentacles, if you will, the various applications out there.
Yes, so we are, I think we're going to start on the coding side. Some of the technologies that have been adopted quickly have been things like Claude Code, the tool we produce to help with development, and we've seen very large productivity gains with that. But we want to go beyond that to more general use of our tool, Claude, and we want to drive usage of the tool across areas like healthcare, life sciences, financial services, public sector, things that Anthropic has worked with for a long time. More broadly, I would say that enterprises have been experimenting with AI for quite a while. But I think really, as Julie said, with the P&L, the important thing is really to deploy these at scale and to actually drive ROI for them. And so that's what we're trying to do. That's why we have this whole business center. That's why we're training 30,000 people to use Claude. And we're going to work with CIOs of companies to track how they're using Claude through Accenture, how they're deploying the tools, what returns they're getting from the tools. So we're going to work with Accenture to manage the whole life cycle. We think these tools are revolutionary. We've seen that from their use inside Anthropic and many enterprises already. But the thing we're most excited for is to make sure that we can really spread these across the enterprise world, and that's where Accenture comes in and can really drive these things at a scale that hasn't been done before.
Yeah, it's interesting, Dario. I mean, you think about AI, some of these LLMs, they're very popular with consumers, individuals. They've been well socialized. But when it comes to enterprises, when it comes to that business customer, you touched on maybe some of the skepticisms that CIOs have in really adopting AI. As you look into 2026, this deal with Accenture, how much further does it put you when it comes to sort of unlocking the enterprise world, and what's the goal when it comes to 2026?
Yes, so we've already seen substantial enterprise adoption. This year, Anthropic's revenue went from $1 billion annualized rate at the beginning of the year to $10 billion annualized rate at the end of the year. So we've already seen a lot of adoption, and 80% of that revenue is enterprise. And within that, particularly with things like coding, but in other areas, we're starting to see very strong ROI. But the scale of this is so large, right? The scale of what needs to be done, right? There's hundreds of billions, maybe trillions of kind of enterprise productivity out there, value to be created. And so that while it has been growing quickly and we've been overcoming that skepticism, I think what needs to be done is enormous in scale compared to what has been done already. And that's why partnerships with Accenture are so important. That we really need to get to a scale that it's a young company needs to partner with someone who really understands the enterprise world.
And Julie, you made the point that one of the big questions here is when we're going to see AI show up in the P&L. There's also the big question of when you see AI really show up in the job market. And I'm curious, whether you're seeing AI slow down hiring for entry-level jobs over at Accenture, for example.
We are really focused on creating sustainable entry-level jobs with AI. And so our pivot in the talent side is how do we now take our entry-level people, or we call them reinventors, coming in and give them the skills so they can operate at a higher level. So for example, if you can now do things that maybe would have taken you 2 years, then you're losing 2 years of experience at clients. So how do we now, we're now introducing communication training to help close that gap. And so we believe it's way too early to call the end of entry-level jobs versus the responsibility that we have as a company and as companies across the globe to change the way that we train and that we think about jobs so that we have sustainable entry-level jobs.
I am curious, though, Julie, as you sort of prep your own folks internally for not only using the tools yourselves, but obviously the idea that these tools ultimately will then somehow be used by clients. What has been the uptake internally? How much retraining have you had to do for your own folks?
Our training has been massive. It starts with, back in 2019, we introduced classical AI training. So when ChatGPT came on, we already had 500,000 people trained in the fundamentals of AI in addition to the specialists. We just kicked off our entire 750,000 or so reinventors agentic AI training. And in fact, this partnership is all about tapping into the talent advantage that Accenture brings, because you need great technology expertise. You also need the industry expertise, like in banking. You need to know be able to know your customer. And so we're training all of our people, those who understand industry and function, and that's a big talent advantage.
So, Dario, but this goes back to the idea kind of what you're contributing, and the idea that a lot of people have been looking for more of a standardized model to be able to work off of. And obviously Anthropic, at least the way as you guys promote yourselves, the idea of open source, the idea of maybe a little bit more transparency. There was a report today in the information that you, along with a couple of others, including Google and OpenAI for that matter, are going to be part of this AI foundation that will seek to create a more standardized system for some of this. Can you talk a little bit about that? Yes.
So this is we're donating MCP, which is called the Model Context Protocol, along with some other things to a foundation. And what MCP is, it's a tool that kind of governs and standardizes how AI models intersect with data. If you think about it, you can think of an AI model as kind of the brain, right? You have a smart brain that knows a lot of things, and when I bring that brain into an enterprise context, there's all this kind of knowledge and tacit knowledge that is present in the enterprise. And so bringing them together is always a challenge. The way I often like to say it is, suppose I took some very smart person off the street and, plop them into the middle of my enterprise, gave them an executive role and say, okay, congratulations, you're in charge, you get to make all the decisions now. As smart as that person is, they wouldn't at least not right away make immediately good decisions. So there's this integration layer that's missing, and I think these tools are designed to facilitate that integration layer and make it easier. And so we're excited to provide these things to the world and kind of make it easier to facilitate access to the technology across the world.
And Dario, before we let the two of you go, I have to ask while we have you, there has been reporting that you've been in early talks for an IPO as early as 2026. Can you confirm that?
Currently, we are just focused on growing our business and growing enterprise revenue as you can see in this partnership.
All right. Well, obviously, it's a great partnership. I've known Julie for some time, and certainly you picked a good partner there. Dario Amodei is the CEO of Anthropic. Julie, great to see you once again. Julie Sweet, the CEO over at Accenture, as we kick you off to the close here on this Tuesday afternoon. A lot to cover. And when we come back, we're going to sit down with the head of Allspring Global Investments. Their new CEO, Kate Burke, going to be stopping by to give us her look at the future ahead. That's coming up next here on The Close. This is Bloomberg.
It's been a big year for Allspring Global Investments. In 2025, the company launched several new ETFs and also welcomed a new CEO, all while stepping back and taking a fresh look at how it can strengthen its investment capabilities in several areas of the market. With 2026 right around the corner, let's welcome CEO Kate Burke to discuss her outlook and goals for the next year. Kate, it's great to see you.
Thank you very much for having me. I appreciate being here.
So you took over the CEO job July 1st, 2025. So it's been just a couple of months at the top slot there. What have the past 5-6 months looked like for you, and what did you prioritize day one?
Well, the good news is that this transition was really well laid out. Joe Sullivan, who remains as our executive chairman, and I had been partnering for almost 2 years. I came in as president a little over 2 years ago and really worked with him on developing a strategy. So this wasn't a pivot. It was more of a continuation in terms of really focused on Allspring as a global public markets asset manager, really focused on a couple of channels, insurance, retirement, and wealth globally. And our goal is to really continue to invest in our investment capabilities in that public market space of fixed income, equities, multi-assets, and liquidity, while really building out a customer enterprise orientation. Clients are obviously at the center of what we do, and our goal ultimately is to be the easiest asset manager to work with. And so that means really investing a lot in our infrastructure and technology to support our organization.
Well, one of the interesting things you said right now is that, you're focused on the public markets here. We know that private markets have been the talk of the town. We've seen a lot of traditional asset managers sort of pivot and, try to get exposure there. Why the focus specifically on publics?
So for us, private credit is a perfectly good asset class, and it has an important role in the overall economy. But we also recognize that whether it's 80, 85, 90, 95% of most individuals' asset allocations are still going to be in the public space. And we believe that by investing in that and in focusing on investing in those investment teams to really bring their capabilities to the front means being really focused at what we're good at, rather than chasing something else or trying to buy something at a high multiple where we would then be distracted by it. So we think by sticking to our knitting, so to speak, is the right way for us to really, I think, add value to our clients.
And there's no worry at all about the shifting sands in the financial markets, the idea that you have a lot more companies that are private, staying private longer, and some clients are going to want access to that?
Well, that's certainly true, that you are seeing private companies stay private for longer. Now, whether that continues or eventually you move back into the public space, I think is a question. You are seeing secondaries, continuation funds, but underneath all of that are more liquid assets with less transparency around what the valuations are. So we think that also creates risk for those clients as well. So every advisor that we're talking to is really trying to manage a couple of things. They're trying to preserve their clients' wealth. They're trying to manage their taxes. They're trying to generate income and preserve legacy. We do the first three really well. And but we think by leaning into the tax management capabilities in particular, which is where our REMI platform comes in. It's our tax managed, separately managed account platform, as well as the launches of our ETFs, really positions us better with advisors so that they can trust us as their partner in solving those problems. Now, whether or not you want a piece of your asset allocation to be in the private markets is certainly something that advisors can consider. But how far and how deep you go, depending on the type of client you want, high net worth client, completely understand why you would have that. But we're still trying to get many people to be investors, period. And they should enter then those markets in classes that are public, transparent, and easily understood. And if we can get more, when we look at our retirement survey, there's lots of concerns still with investors today about whether or not they're well positioned to retire. So supporting that client is part of what we do.
And there's also just the complexity of retirement today. I mean, you mentioned obviously the tax management strategies. That's become even more critical, particularly as people live longer. They have a much wider pool of assets than maybe what they would have had in the past. I am curious as to whether your advisors were already prepared for that demographic shift, the aging of our population, and the idea that you now have an investor class that is going to have materially different demands than maybe what we saw in previous generations.
We've been talking about the wealth transfer for a very long time. So I think most advisors are well understand what's happening with their clients. But that still means that they have to have a nimbleness. And when you think about the changing marketplace, understanding, particularly on the tax management side, that's where a lot of education I still think is happening with advisors. And how do they think about, as you move into retirement, what parts of your portfolio do you access first? How do you create the income that you need while preserving your overall your overall portfolio? Means that there's a lot that we can still do to support those advisors in delivering that outcome.
I do want to get your just general take on economic and financial market conditions next year. I know you're much more of a long-term planner in terms of your job and role, but I'm sure you have to have an eye on some of the shorter-term things and how that affects the long-term story.
Sure. So, look, I think we're going into 2026 with still some volatility in the market. But long term, you know, and even into next year, there are still a lot of tailwinds that are out there. Most companies that we're talking to have figured out how to manage through the tariffs. You clearly have, and their segment before was talking about AI. You've seen a lot of concentration in terms of AI today, but we talk about the second and third wave of companies that are going to benefit from AI. You're going to see increased productivity. That should also help with companies' margins. So we think overall, it's still going to be a good year for the overall equity markets. And then on the fixed income side, look, we have the Fed that's a bit more dovish now. We anticipate that will continue. We do think you're going to see the long end of the tail continue to steepen, which should create, we think, really good opportunities sort of in that intermediate part of the curve and create opportunities to harvest some income while extending duration, leveraging that part of the market.
All right, Kate, got to leave it there. Great to get some time with you as we head to the end of 2025. That is Kate Burke. She is Chief Executive Officer of Allspring Global Investments. Meanwhile, we do have some breaking news about what we broke yesterday. NVIDIA allowed to sell its H200 chip to China. President Trump giving it the green light yesterday. Now, Ed Ludlow breaking some more details about how this came to be. Ed, what do we know?
Yeah, according to a single source, the president was presented with a range of options, from send the absolute latest technology and flood the Chinese market to suffocate Huawei's ability to develop its own tech stack there, right through to do nothing at all, allow no technology to go, even if deprecated. The H200 decision is seen as a kind of best case scenario, because even though it is 18 months behind Blackwell generation at the cutting edge, it is enough where it makes it attractive for Chinese technology companies to use. What's new, and part of this assessment, as I understand it, speaking to this person, is that the administration and the president's advisors looked at what Huawei can actually do at a macro level. Their Ascend 910C chips on a chip-for-chip basis are not competitive with NVIDIA's technology. But at the rack level, when you put them in aggregate, a product that it calls Cloud Matrix 384, where lots of those Ascend 910C chips are used in combination, that compute capability is as performant as what NVIDIA can do, not with H200, but with its Blackwell-based servers. That was presented to the president, as I understand it, along with the information that in the view of some White House officials, Huawei is probably ahead of its ability to ramp next year on the Ascend 910C chip, and therefore its Cloud Matrix offering in aggregate in the millions of chips. And that's beyond what the White House had thought. This calculus, the known threat of China, is something this president understood.
All right, Ed Ludlow there, the co-host of B-Tech here, keeping a close eye on that AI trade as we continue to march towards those closing bells. Let's take a look at some of the other movers out there here on the day, particularly those on the back of analyst recommendations, top calls. And we start with Colgate-Palmolive with RBC upgrading the stock to outperform. The firm saying the stock and earnings estimates have actually fallen enough, creating a more favorable risk-reward setup. The share is up 0.7% on the day. Next up, Eaton. Wolfe Research boosting its rating on the power stock to outperform. The price target set at $413. The analysts seeing tailwinds into 2026, including the potential trough in Eaton's cyclical business, which should fuel outgrowth versus its peers. Those shares up for a second day. And finally, Galaxy Digital. Citizens initiating coverage with a street-high price target of $60 a share. Tailwinds out there, including the multi-year data center build-out and institutional trading strength, creating a structural moat. The analysts write those shares also up for a second day. Meanwhile, we want to take a look at what's going on in the financial space. We're seeing a lot of stocks in that space actually moving lower, despite the KBW Bank Index being higher. It includes names like J.P. Morgan, and it includes names like Goldman Sachs and Citigroup. A big conference being held today, and we heard a little bit earlier from KeyCorp. That's one of the biggest gainers on the day. This after the CEO said it was considering an activist investor strategy. Let's bring in Herman Chan into the conversation right now over at Bloomberg and tell him, just look, a lot going on at this conference. KeyCorp, Goldman, Citi, J.P. Morgan. We've heard from them all, and it's been a mixed bag as to what we've heard. Let's start with KeyCorp.
Yeah, mixed bag, but with KeyCorp, positive reaction because the CEO mentioned they're eschewing any thoughts of bank M&A, which was a big contention, and there was an activist investor holdco that was looking to oust the CEO because of, in their view, poor management of the bank and comments about potentially buying a bank in the Midwest with a currency that's really not conducive for bank M&A. So positive reaction from the market as the interests seem to be more aligned.
Yeah, it's interesting to hear that they're contemplating no M&A here. Are they alone in that view when it comes to some of their peers?
Right. I think that that in itself is also a mixed bag because there are banks that have high currency, high valuations, which makes it much easier to digest an M&A deal. And there are others like KeyCorp that have weaker valuations on a tangible book value basis. So doesn't make sense for them to do deals because it would really dilute their existing shareholders. So we see a bit of a bifurcation where higher quality names like a PNC, a Fifth Third, a Huntington have been doing deals over the past few months, whereas others might be on the sidelines for the time being.
I am curious, Herman. I mean, I know you primarily cover regional banks, but we've heard presentations today from Citigroup as well as from J.P. Morgan. We've heard J.P. Morgan talk about increased expenses heading into 2026. Citi also seems to be alluding to that as well. Is this something, this a story just for the big money center banks, or are the regionals going through the same issue?
It seems like it's happening across the board. J.P. Morgan talked about increasing investments in AI, increasing inflationary costs, and also relatively some growth drivers that are driving expenses higher as well. So that's really, that part of the story is actually pretty good because it contemplates higher revenues. But then some regionals like Citizens also mentioned higher expenses as well. So it seems like that's happening across the board as banks continue to invest in branches, expanding AI, rejiggering their operations. That's really driving some expenses higher.
All right, Herman, really appreciate your insight. That is Herman Chan. He is Senior U.S. Regional Banks Analyst over at Bloomberg Intelligence. A quick check on markets here. Of course, we're just over 30 minutes away from the closing bell. The S&P 500 flipping to negative. That is the public market story. Up ahead, J.P. Morgan Asset Management flagging immense opportunity ahead in private markets. We'll talk to the firm's global head of private markets, Jed Laskowitz, up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on markets that aren't doing much of anything when it comes.
Is there a reason why that shot didn't show the now iconic JP Morgan building, which is now just dominates the New York City skyline?
You know, I was wondering that because it's pretty hard to miss.
I mean, it would have been a nice segue. Shining
brightly in the skyline there. Speaking of segues, we were hoping to show that building because JP Morgan Asset Management is out with its 2026 Global Alternatives Outlook today, emphasizing the, quote, immense opportunity in private markets. Joining us live in studio, I'm pleased to say we have Jed Laskowitz. He is Global Head of Private Markets and Customized Solutions over at JP Morgan Asset Management. Jed, it's great to see you.
Great to be back.
So immense opportunity. Of course, we're talking about an immense market when it comes to global alternatives. Talk us through where you have the highest conviction when you take a look into 2026.
Sure. You know, private markets have really gone mainstream. Really, private markets started with institutional investors and wealthy individuals, and this is a market that now will be forecasted to be $30 trillion, $20 trillion today. As we look across the near term, there are a number of opportunities. You know, first, infrastructure. Increased energy demand. This is not just an AI story. That's only about a third of the electricity demand. We see electricity demand growing at roughly 2 to 5% for the next 2 decades. It's been flat from the prior decades, and this is about the electronification of absolutely everything. AI is also obviously a story that's dominating the headlines in technology and private equity. Companies are staying private for longer. The average time to IPO is about 14 years now. That was 5 years in 1999.
14 years. Wow.
14 years. And now these companies are getting larger while they're private. So we might see in the next year $1 trillion private company. That's possible. I put this into our LLM suite and said, well, what do you call a private company that's $1 trillion? And it came up with kilocorn, like the unicorn, but I kind of like dragon as better. Yeah. So companies are staying private for longer. And it's just an interesting time to be thinking about investing in public companies because a healthy public market is good for private markets and also investing in private companies. So think late stage companies, Series B through pre-IPO, into the IPO market and public companies presenting some unique opportunities. Right. And then maybe one more, real estate, a more unloved asset class since COVID. There have been 3 pullbacks like this in the last 50 years. This is the most interesting one because although asset values have declined, income growth has remained consistent. And falling rates, we should get a 25 basis point rate cut tomorrow, is good for real estate.
Let's dig into what you were saying about private for longer specifically, because private for longer isn't necessarily private forever. We have a great story on the Bloomberg terminal today talking about the big 2026 expected for IPOs. Bank of America's head of equity capital markets for the Americas saying that their teams are flat out when it comes to preparing for that. What does that mean for private equity, the fact that you do have IPOs coming back?
I think it's great for private equity. Now, we're still at a period where distributions are slow. For every 3 investments that are made, there's only 1 distribution. That's the lowest it's been, in a decade. But a healthy IPO market is really good for private equity. But there are other forms of liquidity that are being created. The secondary market is as large as it's ever been, roughly $650 billion. It will be another record year for secondaries. About half of that will come in the form of continuation funds. But as the IPO market and the M&A market continue to recover, that will obviously be good for private equity. It doesn't mean there aren't opportunities given the fact that distributions are slow. There's just more competition for capital. There's about $3 trillion right now of funds out raising and really only about $1 trillion of capital that are out there looking for investment. So it's a tough fundraising environment, but I do think investors will start coming back more and more as the IPO market improves.
But with those investors, and I'm primarily talking about the traditional LPs, institutional type investors, are they kind of tapped out as well? Because we talk about this idea of obviously we haven't had the level of distributions that some of them anticipated, but a lot of them, at least the ones that we can see publicly, are already bumping up against the caps of what they're allowed to even allocate to private investments.
Yes, some are. On a global basis, there are a lot of global investors, still allocating, to private equity. And you're right. I mean, this is why we're seeing allocations to asset classes like infrastructure double and then forecasted to double again because of of the income generation that comes from asset classes like infrastructure. So while some investors do take a pause while they wait for distributions to come back, that's just natural. I think we have a healthy private equity market, and it's going to continue to have a good year next year. And secondaries are a healthy part of that. The discounts, ranging from maybe 5 to 15%, maybe a little wider in VC and real estate than that. The secondary market is active, and there's some excellent investment opportunities.
We've seen that secondary market boom to a large extent, and I know that's been a big benefit not only to the folks on Wall Street, but to a certain extent the companies themselves. There's been some criticism that boom in the secondaries is just masking what a lot of people would like to see, which is just a true mark-to-market on some of these assets.
Yeah, I mean, valuing assets correctly is obviously incredibly important, particularly in evergreen vehicles. We're talking about the institutional world. There's been a lot of innovation around vehicles that are accessible to a wider range of investors. I do think a healthy secondary market is good for the private equity market because creating more liquidity, for investors and institutional investors have the ability to analyze this market and make really good decisions.
I have to ask, speaking about secondaries, I keep thinking about in November, we saw State Street actually take a stake in Collar Capital to basically tap into that secondaries boom that Romain described. Are you over at JP Morgan Asset Management thinking about something along those lines, whether it be a stake, whether it be, going out and pursuing an inorganic opportunity to maybe capitalize on some of the things we're talking about?
Yeah, I can't comment on anything like that, but what I will say is, we have a really broad platform that participates in a number of different areas across the private market universe. We're really thinking right now on a sector and asset class basis, what are the areas that we're viewing as most attractive as we go into next year? One of the other areas that I think kind of relates to some of the question is, how do investors get access to private markets in a way that's risk controlled, sized appropriately, particularly for individual investors? And this area, that I know, Katie, you're really familiar with, which is areas like model portfolios, where you take portfolios of ETFs, individual securities, and privates, and you put them together inside an asset allocation that's run on a discretionary basis. And these are parts of the market where I think individual investors can really benefit from having a professional investor help them size those strategies.
All right, Jed, really appreciate you being here. Jed Laskowitz, Global Head of Private Markets and Customized Solutions at JP Morgan Asset Management. And some breaking news crossing the wire, and actually relates partly to what Jed was just talking about here. SpaceX, the private valuation of which continues to go up. And now we're learning, based on people familiar with the situation that our Bloomberg reporters have spoken to, the company is planning to move forward with an IPO in 2026. Based on the reporting, it says that it would target a valuation of about $1.5 trillion for the entire company. Remember, Bloomberg reported just a few days ago about the most recent funding round for SpaceX that valued at somewhere in the range of about $800 billion. We should point out that this is all still tentative. The company has not confirmed this, and according to our reporting, the timing of this could slip, Katie, into 2027.
Yeah, just fascinating to think about the implications here. SpaceX, obviously one of the poster children, if not the poster child, for that private for longer idea, basically, that you can get all the funding that you need in the private markets. To see SpaceX considering entering the public markets, certainly an interesting time of the sign of the times. Just to repeat that headline, this is based on reporting that SpaceX sees a valuation of about $1.5 trillion should it pursue that public offering.
Yeah, and also the story says, based on our reporting, that they would actually use that money to develop space-based data centers.
No kidding. Another sign of the times.
All right, we continue our focus here on tech as we count you down to the close. When we come back, well, we're going to lean in a conversation with Sheryl Sandberg. That's coming up after the break. Stick with us. This is The Close on Bloomberg. All right, after years spent leaning in at work, professional women, they may actually be leaning out. There's a new study out from the advocacy group leanin.org and consultant McKinsey, finding that compared to their male counterparts, fewer women are interested in big promotions. It's the first time a gap like this has happened in the survey's history, and it's something that Sheryl Sandberg, the former COO at Meta Platforms and author of the book Lean In, is passionate about. Pleased to say, joining us right now is Bloomberg Originals host and executive producer Emily Chang. She joins us right now with Sheryl Sandberg. Emily?
Romaine, thank you so much, and Sheryl, thank you so much for joining us. I know this ambition gap is troubling to you. Essentially, women are leaning out. They're deciding they don't want to be promoted because it doesn't seem worth it. After all the work that's been done, all the talk, what do you think broke?
Well, let's start at the top. So not all women are leaning out and not all companies. But what our report shows this year, this is our 11th year, is that about half of companies no longer prioritize advancement for women. And 21% of those companies say women's career advancement is a low or no priority at all. And those are the companies that participated in the Women in the Workplace report we do with McKinsey. And so these companies in many ways are the best of the best. And then we do see that ambition gap, but only when women don't get the opportunities and support they need.
How does this put companies at risk? Or is the conventional wisdom that this is better for business not ringing true?
I think the conventional wisdom should be and is what's true, which is that when you get the best out of your whole workforce, you're going to do better. So what's happening is that women face more barriers at every level of the career. Entry level, we call it the broken rung, and we see it every year. For every 100 men that get promoted, 93 women, 60 black women, 82 Latinas. That's because we hire and promote men based on potential and women for what they've already proven. So of course, women can't prove they're a manager. Then at the senior levels, our report shows this year that at the same levels, a man is 70% more likely to get tapped for leadership training. Think about what that says. You're a future leader, come to leadership training. And so this is only happening in the companies that aren't doing the right thing. When women get the full support and the same stretch opportunities, they're not leaning out at all. And so it's a question of economic productivity. Do we want to get the best growth in our economy? Do we want to get the best out of our workforce? We're at a fork in the road, and companies have a decision to make.
The Trump administration is pushing policies that explicitly try to incentivize women to have more babies while simultaneously weakening workplace protections. Do you see these natalist policies, as they are called, as pressure on women to return to traditional roles, or is it support for families?
I mean, look, women can have as many kids as they want and still have to go to work. I think what we forget in a lot of this is that the great majority of women do not have the choice to be a full-time mother and a full-time spouse. Now, I feel we sometimes come up with new language for old ideas. And I want to be clear, if you can afford to be a full-time spouse and a full-time parent as a man or a woman, and you want to do that, I think that can be deeply fulfilling work. But we've got to remember that most women don't have that option. They have an economic reality that they have to wake up in the morning and leave their home to earn money to support their families. And so, again, new language for old ideas, trad wife. That's just telling these women that have to leave their home that it's going to harm their marriages and their kids. That's not what the data supports. We should be able to make any choice we make without putting old pressures on women in the modern workforce where that's not the economic reality they live in.
President Trump has called on companies to root out what he calls illegal DEI, threatening federal contracts, threatening regulatory action. How is this going to be looked back on? How is history going to look back on the DEI rollback?
I think people didn't understand and thought that women were getting unfair treatment. But let's throw some numbers at this. Women got 59% of the college degrees, and women are 10% of Fortune 500 CEO jobs. I'm not saying there aren't times when people are given preferential treatment. Of course there are. But on average, in our economy, do you really think that 59% of the college degrees getting 10% of the jobs means there's systematic special treatment for women? I mean, my experience in the workforce, and I think yours and a lot of people's, is that it was hard. It was hard to be one of the only women in the room. And so the question is, what can companies do? And I'll tell you, there's a lot they can do, and it's in our report, and it's completely legal. So for example, feedback. 1% of men get style-based feedback in performance reviews, and 66% of women. What can companies do? You establish criteria in advance that everyone agrees to that are universally applied. everyone gets this kind of feedback, that is not just legally permissible, but allowed and encouraged, and creates a level playing field. This isn't about special treatment. This is about giving everyone the opportunity to do their best work and contribute.
Meta is among many companies that have rolled back DEI policies, and Mark Zuckerberg reportedly blamed you for the policies being there in the first place. Some employees have felt that your legacy is being dismantled. What have your conversations been like with Mark about this? I know you're still friends, and you have to have feelings about this.
I don't think that's exactly what happened in that meeting, and Mark went out and publicly posted and clarified. But here's what I would say, is that every company, including Meta, has the opportunity to make sure that they're fair to women. Here's what the data shows us over and over and over again. So many examples. When a man and woman ask for raises or promotions, the woman's 30% more likely to be told she's too aggressive. What do? Standardize your processes. Every company should be doing it. So for example, interviews. If you don't have agreed upon questions you ask, naturally, and maybe not on purpose, but naturally, people sometimes ask the easier questions to the men and the harder questions to the women. Just standardize your questions. Put systems in place that protect people, but also that just give people the opportunity to contribute.
You have to acknowledge that there's a big rhetoric shift happening. And obviously, we're seeing it in Silicon Valley. We are seeing people, tech leaders who said one thing in the last election, now whispering in the president's ear. A lot of these people that you know personally. What do you think is happening here? Is this transactional? Is this just business? Or is this a real change in values happening?
I think a lot of the rhetoric is terrible. And I think we see some of the impacts in this report. But, I'm 56, so I've been in the workforce. This is my 4th decade. And what I see is that we make progress, we backslide. We make progress, there's a backlash. I think the reason these ideas take hold so easily is they were never really gone. Even though the rhetoric is bad now, do I really think we ever fully encouraged leadership in little girls and little boys and women as much as men? No. So when it happens, when this rhetoric happens, it's so easy to take hold because it's like fertile ground. I'll give you one that really scares me. 8th and 10th grade boys, middle and high school boys, they surveyed them in 2018, and they said, what do you believe women should have the same opportunities as men in the workforce? In 2018, 63% said yes. I could spend all day talking about why that's so upsetting, like, where are the other 37%? But 63% said yes. 63% said yes. Today it's 45. We are seeing that same double-ditch slide in middle and high school boys believing that women should get equal pay. That's not okay. And what it's going to take to change that is, I think, people realizing that this is about economic productivity. This is about, do we want our companies to succeed?
You built 2 companies, helped build 2 companies that are incredibly economically productive. We are in the middle of this massive AI moment where companies are investing a lot, but it's also total chaos, it seems, for, within and among some of these startups that are trying to build sustainable business models in an AI moment. What's your advice to companies right now about how they build a business model that can work and survive in the age of AI?
It's such a good question. And I was at Google in some of the early years, and then I went to Facebook, now Meta. And I do think there's times when it really makes sense to invest ahead of revenue and business models, right? If Google, when I was there in the early days, had tried to cover our costs for search, we never would have gotten enough search out there to get enough user feedback to improve the search results to get to what was a great business for Google. So it makes sense. At some point, at some level, you have to have revenue that covers costs.
Is that from ads?
Well, people make it so complicated. It's not complicated. Ready? Someone has to pay. Who can pay? Businesses can pay. They can pay via advertising. They can pay via paying in some way, shape, or form for database services. Or people have to pay. And it will be a combination of all of these things. But over time, the revenue is going to have to cover the costs.
All right. Sheryl Sandberg, author of Lean In, obviously helped build Facebook and Google into what they are today. Guys, I'll send it back to you in New York. Thank you.
And our thank you to Bloomberg Originals host and executive producer Emily Chang, and of course, Sheryl Sandberg. She is the former COO over at Meta Platforms. Now, we do have some more breaking news. Let's get back to Bloomberg Tech co-host Ed Ludlow. This SpaceX scoop that SpaceX said to pursue a 2026 IPO, Ed, that would be at a potential valuation of $1.5 trillion. SpaceX, as we've been discussing, one of the poster children for staying private for longer. Why does a company like SpaceX potentially need to tap the public markets?
Because they do need capital. You know, Elon Musk has posted a lot recently about their cash flow position, why they don't need cash. But what I understand from sources is the reason they're targeting a raise of more than $30 billion, significantly more than $30 billion, is that alongside all of SpaceX's other long-term goals, with Starship in particular, they are looking at the market potential of space or constellation-based data center, satellites that act in constellation and aggregate as data centers, where SpaceX needs the capital to buy the semiconductors, buy the chips. So that's what we understand from our reporting. Mid-2026 is the goal. If they raise more than $30 billion, from a dollar raise perspective, that's the biggest IPO of all time. The valuation, that will come out in the wash, right? It depends on the price that's settled by the bankers, by the demand that's out there, the percentage of the company they're willing to offer. But that's what I understand from the people I'm speaking to. 1.5 trillion is an approximation. And for what it's worth, by the way, we confirmed that the tender offer, which is where employees can sell their shares internally, settled at $421 per share, valuing the company at $800 billion, $2 billion volume, and SpaceX is buying back some of that stock. But the reason that the tender is relevant here is that the company also wants to settle the valuation, something closer to fair market value ahead of this big IPO, which, management is telling people that this is happening.
All right, Ed Ludlow there. Of course, this would, of course, be one of the biggest IPOs of all time. But, of course, as we march to the closing bells, we need to move back to the public markets and continue to sort of look at what's been driving and the holding pattern that we've been in as a lot of people await the outcome of the Fed's meeting. Saira Malik joins us right now, CIO over at Nuveen. And, Saira, I do want to start off with this bull market, which seems like it's been a bit on pause over the last few weeks as a lot of people take profits into the end of the year, but also look ahead into 2026. And I am curious about the potential opportunities for reinvesting in this market and if that money just goes back into some of those mega cap tech names.
Well, Romaine, Santa Claus may have come early this year for 3 reasons, and that's because of the hawkish Fed cut expected tomorrow, the weakness in momentum stocks, and also questions around the labor market. Let's start with the Fed. I think we'll get 25 basis points tomorrow, but a hawkish tone from them. And if you look at the first quarter of next year, we're pricing in less than 1 rate cut for the beginning of 2026. Second is your key question on momentum stocks. We're seeing those weaken while other areas of the market broaden out, like small caps and financials. If you look at history, 9 out of 10 times in December, momentum stocks are weak. I think it's a seasonal trade and that they will pick up steam again, maybe even starting this Thursday when Broadcom reports, but definitely going into 2026. And then finally, labor market. JOLTS numbers out today. Labor market is not collapsing. It definitely is slowing, but I think the labor market is still holding up to a moderate degree. So I don't see a recession being imminent, and that's positive for equities in 2026.
What does that mean for fixed income, of course, as we count down to the Fed? Seems like tomorrow is a lock. As you mentioned, the picture when it comes to next year, much murkier. And if the labor market is holding up, if you still have, these inflation pressures, how does that translate into monetary policy?
Well, let's take the other side of the bet on a bullish market for 2026. 2 issues that I see could happen next year. First is, of course, inflation could bubble up again, especially as everything reopens post the government shutdown. And the second, watching rates on fixed income. The 10-year is starting to back up. If that continues, that could be negative for the market. So in fixed income, we're in the higher quality area of the markets. We're not chasing duration. We like areas like emerging market debt. That's an area where it had been weaker earlier this year because of the fear of tariffs. That's reasonably behind us now in terms of certainty. So we like emerging market debts and also senior loans, higher quality areas of the market.
Sarah, I have to leave it there. I have to get some more time with you in the future. Sarah Malik, CIO over at Nuveen, counting us down to the closing bells here on this Tuesday afternoon, where we took a look at an S&P 500 on the back foot for a second straight day. But quite frankly, most of the broad market right now has been in a bit of a holding pattern for really the last 4.5 to 5 weeks. That could change tomorrow at about 2 p.m. Eastern time with that Fed decision. And don't forget, we get several big tech earnings as well, including out of Oracle and Broadcom the following day. A full breakdown of all of today's market action starts now. And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. It starts now. Carol Massar and Tim Stenovic joining us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, television, radio, as well as our partnership with YouTube. We're going to get this actually back on track here. We count you down to the closing bells with dynamism and context, because I'm told, Carol Massar, context changes everything.
It totally does, totally does. Listen, it's all about that Fed decision tomorrow. You've got a market that's little changed here, a little bit higher on the NASDAQ 100, a little bit lower on the S&P 500. We're just waiting to see what we get. It's not really about the rate cut that's widely expected, pretty much baked in, but it's just about what maybe happens in 2026. Increasingly, Tim, we have folks saying maybe one more move next year. Maybe it doesn't happen till May. I mean,
that's what I was going to say. Joyce Wong from American Century Investments, she was in our studio just about an hour ago, and she said, okay, tomorrow, all well and good, we know what's going to happen, but we think in 2026, there's just going to be one 25 basis point move from the Federal Reserve lower.
Yeah, certainly. You're hearing more and more of that type of talk. It's interesting, though. You take a look at today's action, specifically volume falling off a cliff on the S&P 500, about 14% lower than the 30-day average. Certainly tells you that all eyes are on tomorrow for the Fed, but also we get some big tech earnings after the bell as well.
Yeah, I think it's kind of interesting, too. It kind of got lost in the shuffle, but you get Oracle and I think Adobe tomorrow and Broadcom, I believe, the following day. And it gets to this idea here that as we hear more from these companies and how these companies in their commentary to a large extent has replaced a lot of the economic data, not just because of the government shutdown, but just because it's providing a little bit more clarity in terms of where the spend is, both on the business side as well as on the consumer side as well. Another day of that holding pattern as we get the closing bells here in New York with the Dow Jones Industrial Average leading most of the declines today, down about 0.4%. The S&P relatively unchanged, down about 6 points or 0.1%. The NASDAQ holding modest gains on the day, up by about 1 to 0.2%, depending on where you're looking at the composite or the NASDAQ 100. And your outperformer on the day was the Russell 2000, modestly speaking, only up about 0.2%.
All right, so little moves there. Let's go back to the S&P 500, if I may. 215 names in that average, higher for the Tuesday trade. 286 to the downside, Katie, 2 unchanged.
All right, let's take a look at the sector level. You had 6 sectors finish in the green, 5 in the red. The tech sector actually leading the way here on a points basis, only higher by about 0.2%, but we know it's very important. Energy, in terms of percent, was your biggest gainer on the sector level, consumer staples. Then you take a look at what didn't do too hot today. Healthcare bringing up the rear, that sector down about 1%. Industrials and real estate also falling a bit today, Carol.
All right, so let's get to some of the individual gainers in today's session. Got to talk about CVS Health. That one at its highs up more than 5%, finishing the day with about a gain of about 2.25%. Company raised its full-year profit forecast that earnings would rise in 2026, a sign of hope. As you know, it's not been an easy backdrop, certainly for this company, the retail environment, government scrutiny really across the healthcare industry. Keep in mind, too, that stock is up about 75% year to date. Going to go to Ares Management. At its highs, up 9.4%, finishing the day with a gain of about 7.3%. This after the S&P Dow Jones indices said the stock will replace Kellanova in the S&P 500. That's effective December 11th. You know what happens? All those index fund managers are going to have to buy it. And so you saw investors certainly moving into that name. And for
but this is, I gotta just say though, too, this is kind of
interesting. It was also a surprise, too. This one.
Yeah, definitely a surprise, but also the idea, I mean, we talk a lot about private investments, private equity, and private credit, and the idea that this is, to a certain extent, kind of a coming of age, if you will, of the industry writ large to see a company like Aries basically rise, from 25 years ago of basically being nothing to now today, or at least in a couple of weeks, being in the S&P 500.
Yeah, no, right.
Yeah.
Like quite a journey to see it. What goes in, what goes out really tells a story. And this tells a story. Well, actually, this is just something different I thought I'd throw in there. Mama's Creations, and the ticker is Mama.
What?
Yeah, exactly. I have never heard of this company. It's a $525 million, $552 million market cap company, so it's kind of small.
Are they going into the S&P too?
No. But they're up 28% in today's session.
What does Mama create?
It's like a bunch of brands. I'm not familiar with them. I don't know if you know them.
I see you're really prepared for this here.
Mama Mancini's, Crown One, Creative Salads, the Olive Branch.
Oh, yeah.
Okay.
Salads, soups, other foods.
It's a national deli solutions company.
Delicious.
Yeah, okay. Go
Deli
to their website.
solutions.
Did you know that already,
Wait,
Romaine?
what got into you?
All right, the news. Can I get to it?
Yes.
Okay.
Yes, you
I said fiscal third quarter revenue grew 50% from the year-ago period, fueled by the acquisition of Crown One Enterprises. So it's been acquiring companies, and so
Bull market and deli meats.
I know.
Yeah.
What could Yeah, love me some deli.
Go meat.
Food.
All right, let's talk a little bit about some stocks in the red today. Shares at JP Morgan Chase fell 4.7%. Marianne Lake, the CEO of Consumer and Community Banking, said the bank anticipates spending $105 billion next year. This was at an industry conference. She said that outlook surpassed analyst estimates, and sent shares falling today. She said the biggest driver of the expected cost growth is, quote, volume and growth-related expenses. She pointed to strategic investments and the structural consequence of inflation. She said consumers and small businesses, though, look healthy, but the environment is a little bit more fragile with less capacity to weather incremental stress. Once again, shares of JP Morgan Chase falling 4.7%. Also, keep an eye on shares of Pfizer today. They dipped just in the 2 o'clock hour, sort of later in the session. This after Bloomberg News reported the FDA is investigating whether COVID-19 vaccines cause deaths in adults as part of a safety review that's broader than was previously known. A spokesperson said, quote, the FDA is doing a thorough investigation across multiple age groups of deaths potentially related to COVID vaccines. Shares of Pfizer falling today by 1.7%.
To COVID vaccines?
Yeah, COVID vaccines.
What's the death rate from COVID?
Wow.
The story does say that scientists, I'm going to get the wording wrong here, but you know what I'm going to say, Romaine, like it's widely considered to be a safe and effective vaccine. So
I hope so. I got a COVID shot a couple weeks ago.
Yeah, but look, investors certainly concerned. We also saw shares of Moderna dip and BioNTech dip as soon as that news broke. Yeah. Finally, GoGo, ticker GoGo US. This is the in-flight Wi-Fi provider.
Yeah. Have they finally gotten that to work better?
No, they haven't.
Oh.
Well, maybe. I think the thing that investors are concerned about is that Starlink is going to replace GoGo on some flights, specifically some NetJets planes. Have you guys been on a plane with Starlink? I was on a United flight recently. I was just telling Carol.
Yeah.
It was game-changing, completely different than any other in-flight Wi-Fi experience I've experienced.
Yeah, I've not been on one.
It's amazing.
But I've heard everyone.
You can actually get your work done.
Basically, just says it said nothing bad about it.
Yeah.
And, we had a big scoop on SpaceX a little bit earlier.
I did, yeah. It's IPO coming next year.
Yeah.
It'll be $30 billion. Potentially.
Yeah, potentially. Yeah.
Yeah. Eric Johnson's going to be joining us in just a minute.
Oh, you got Eric Johnson. We got Ed Ludlow, but he was just on the telephone for some reason.
We don't have the technology yet.
Let's check in on yields real quick here, too, because we talk about this march higher in yields into a Fed meeting where most people anticipate an actual rate cut. Keep in mind, on your 2-year yield, 7 of the past 10 sessions, including the past 4 straight, we've seen yields move higher. The 10-year has been even more extreme to that. And guys, I was going back, looking at every Fed meeting in recent history, trying to find the last time you saw a meaningful ramp up in rates into a meeting where everyone expected rate cuts. And honestly, I gave up after a few years because it was just hard to really find anything to ratify that. Carol.
All right, I want to go to GE Vernova because this stock is popping up about 4% in the after hours. We mentioned boosting a buyback to $10 billion from $6 billion and doubling its dividend to 50 cents. But here's what maybe has caught investors' attention as well. The company getting into the outlook sees 2026 revenue $41 billion to $42 billion. The estimate on the street is $41.54 billion. It also sees 2026 adjusted free cash flow of $4.5 billion to $5 billion. That's way above the street estimate of $3.02 billion, and still sees fiscal year revenue at the high end of $36 to $37 billion. The street estimate is a little bit above that, $37.32 billion. And fiscal, yeah, I got through that, all of that. So anyway, that stock's up about 4.3%. So yeah, moving in the aftermarket, guys.
Let's take a look at Cracker Barrel. Totally different story. Shares falling off a cliff right now, down about 13%, reporting that first quarter revenue came in light, just under $800 million. The expectation had been for a hair over $800 million. Then you take a look at some of their comp sales here. First quarter restaurant comp sales declining 4.7%. The estimate had been for a decline of about 4%. Their retail comp sales, because of course, you know, Cracker Barrel has the cute store next to the actual restaurant, those declined 8.5%. The estimate had been for a decline of 6.5%. We've been keeping a close eye on this company after that midsummer logo snafu. They ended up reversing, but clearly still nursing some of the after effects.
What was the snafu again?
They changed the logo from their classic old-timey logo into
Old-timer.
Old-timer, old-timey.
Okay.
Thank you. But
No, that's what his name is, the old-timer.
The old-timer.
Right?
I'm sorry.
And they got rid of him?
If he's listening, yes, they got rid of him. They planned a little revamp there. It did not go over well. And you take a look at the year-to-date chart of shares, you can see exactly when they made that decision. And interestingly, the reversal hasn't stopped the decline, and it's certainly extending in the after hours right now.
So that's because of the logo, not because of anything else.
That is the understanding.
So they just had the barrel, right? They got rid of the old timer?
They got rid of the man, the old
and they just had a logo. I mean, just had a barrel, right?
I don't think yeah. The criticism was that they took, you know, the personality out of it.
Oh.
Okay.
But
just a logo.
I'm just going to do something briefly on Dave & Buster's. It's lower in the after hours, down by about 5.8%. Comp sales were down 4%. Third quarter loss per share coming in at $1.22. Third quarter entertainment revenue coming in below estimates at $279.4 billion. Third quarter revenue coming in below estimates at $448 million. Dave & Buster's shares down about 5.4%.
GameStop shares also down here after reporting its latest quarterly numbers. Sales growth, no growth. Net sales down about 4.6% on a year-over-year basis, and pretty much that's been the trend now for the last several quarters. A negative sign in terms of that revenue number. Of course, nothing really on the bottom line when it comes to profitability, and the shares for the meme stock, at least right now in the after-hours trade, down about 5%.
Yep, on top of a 26% decline here in 2025 for GameStop. All right, guys, that is a wrap. Across platform radio, TV, YouTube, Bloomberg Originals. Romaine and Katie continuing there on the close on Bloomberg TV. Tim and I continuing right here on Bloomberg Business Week Daily on Bloomberg Ready. We will see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. We're going to set you up for that big Fed decision tomorrow. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Another middling day on Wall Street. There's a lot of folks really waiting for kind of the next two big catalysts for this market. The Fed meeting, the Fed decision tomorrow, as well as a spate of three key earnings that we're going to get over the next 48 hours out of names like Broadcom, Oracle, and Adobe. A better read here on the sustainability of the AI trade. The S&P basically flatlined here on the day, though we should point out the Russell 2000 did finish in the green, though did stop just shy of its all-time high. Bitcoin trying to get its mojo back, but I feel like we bumped back up above this 90,000 level only to have our hearts broken a day or two later. But silver on a tear right now. That gold trade is now seemingly turned into a silver trade. Another record high here for the silver metal, and yields continue to push higher, Katie, into that Fed meeting.
The devil's metal getting a bid, silver up on the day. Let's talk about some of the individual movers on this Tuesday. Warner Brothers, we know that they're at the center of a very hostile bidding war. That was worth another nearly 4% rise for Warner Brothers Discovery. JP Morgan, as we were discussing with our friends in radio, some of the company's top brass coming out warning of higher than expected costs, knocking JP Morgan down about 4.7%. And then I threw NVIDIA up there as well. Of course, we've been watching the shifting sands when it comes to the Trump administration and China. NVIDIA down about 0.3%. Meanwhile, of course, our top story this hour is the countdown to that Fed decision coming tomorrow. And in about 24 hours, we will know exactly what this Federal Reserve is going to do. While tomorrow looks like it's going to be a lock for a rate cut, we know that doubts are growing, Romaine, about what we can expect in 2026, whether the bank will be able to delivering the easing that we know the Trump administration wants as we consider the balance between the labor market and what's going on with inflation.
All right, well, here to discuss is Christian Hoffmann. He's Thornburg Investment Management's portfolio manager and head of fixed income. And Christian, I do want to start off first, not so much with rate expectations for the Fed, but the idea of what the Treasury market right now is actually telling us about how it views Fed policy. Because I take a look at a two-year yield today at 3.6%. And believe it or not, that's actually higher than where it was back in mid-September when the Fed ostensibly started this rate-cutting cycle. Similar story for the 10-year. What's going on?
So I think some of this is positioning into year-end and ahead of this meeting, but probably the biggest thing that's happening in the background is the evolution of who will be in charge of the Fed. So if you think about this meeting, I actually am not expecting a lot of surprises. I think markets are pivoting between low 90s and high 90s% of a cut. I think it's 100%. I think we get a cut tomorrow. I think we're still going to get some optionality. Powell obviously created a lot of optionality in the October meeting going into this meeting. But he's going to try to create optionality on the path forward. However, he's going to turn into a lame duck pretty quickly. It seems like Hassett is the preferred candidate. It's not a done deal, but it's something like a 70 to 80% chance at this point. And that announcement should come early in the new year, which is potentially less than a month from now. So that introduces the concept of a shadow Fed, of someone opining and taking pot shots from the sidelines. Yeah. It also questions the evolution and where we go from here. So I think the Treasury market is grappling with all of those things in the background, which are a much bigger deal, in my opinion, relative to what's going to happen tomorrow. But does that mean then that the market is going to basically have to deal with this or find a way to cope with this for another, 5.5, 6 months? I mean, technically his term doesn't end until May. So assuming he rides that out, I mean, you say he's becoming a lame duck. I mean, I'll just tell you right now, based on Bloomberg reporters, we've already turned him a lame duck because there's like 10 stories on the Bloomberg terminal today that have lame duck in the headline. Yeah, absolutely. He's not a lame duck, and he could decide to stay on, which I think would throw, a wrench in, some people's plans. If I were him, I wouldn't do that. I think that'd be a thankless job. But if he wants to be obstinate and maintain a voice, I could certainly see him doing that. But think about this idea of a lame duck. Also think about this concept of what a Hassett or a more dovish Fed might look like. And I'd actually push back against that. Certainly you could have had a more provocative potential choice. On paper, Hassett looks very much like someone you would consider for the job. PhD in economics, background with the Fed. But I think important for the executive branch, it's someone that has worked with Trump for 2 administrations, that clearly has loyalty, that's been very vocal about being pro-dovish policies in the near past, and is viewed as an outsider for an organization that has increasingly come, under fire from the executive branch. On the other hand, I think you need to think about how does a new Fed chair come into this seat and what do they need to do, and look back at precedences and the analog going back in history. So one thing every Fed chair has had to do, or at least historically has had to do, is really establish their credibility from day one as a legitimate inflation fighter. If you're not doing that, you're really introducing a lot of volatility to Treasury markets, and you're really making the market feel uneasy. And I think no one wants that. And the other thing you have to think about is this is not a monarchy. This is 12 people making a decision together. And really he is if it's Hassett or someone else, it's going to be someone that is likely going to appear more sympathetic to Trump. And I think the existing members of the Fed are probably going to view that person with a skeptical eye. And that person is going to need to come in and build consensus because, again, it is still committee and not a monarchy.
Well, let's game plan a little bit here. Let's say we do enter into a situation where, whether it's Kevin Hassett or it's someone else, someone who looks to lower rates aggressively come the new year, and you have an economy that isn't quite backing up that move. How do you think that the bond market would react? What specifically do you think that the long end might do, where we've seen a lot of pressure recently?
We've seen pressure. Certainly, we've seen higher rates, and we've actually seen an administration that appears very uncomfortable, and we start to flirt with 5%. We're notably inside of that today. I think we also need to keep in mind that this is still happening 6+ months from now, And I could make a strong case how the economy in the world could feel notably better than it does today. I could also make a strong case of how it could feel notably worse. I think Powell had the comment in October of saying, we're looking through the fog. Part of that has been lack of data and bad data that's clearing a little bit, but that's also happening amidst the backdrop of a changing economic environment. So you're having a changing economic environment, you have a lack of data, you have bad data, all those things are making all of our jobs harder. All those things should push volatility higher. Those things, when we didn't have data, were abnormally pushing volatility lower. So, as we look at 2026 in fixed income markets broadly, again, it feels hard to get a lot of outside performance from credit spreads given the very tight levels that we have. So I think the risk is to the downside there. And for interest rate markets and treasury markets, I think you need to be looking at more volatility from what had been coming down.
All right, more volatility ahead. Christian, great to get some time with you. That is Christian Hoffmann. He is Thornburg Investment Management's portfolio manager and head of fixed income. Now, coming up, some green shoots on the small business front with sentiment reaching a 3-month high. That is according to data from the NFIB. Holly Wade, she is executive director of the NFIB's research center. She joins us next. This is The Close. Small business sentiment climbing to a 3-month high on an improving sales outlook. 15% of small business owners, that is the largest share since the start of the year, are expecting higher sales volume over the next 3 months. That is according to fresh data out of the NFIB. Joining us now live is Holly Wade. She is executive director over at the NFIB Research Center. Holly, great to have you with us. Give us some context around that 15% who expect higher sales volume, because just in isolation, that doesn't seem like very many.
So small business owners, they've been met with a number of challenges over the last number of years. And the last Small Business Optimism Index did improve in November. And so, as you mentioned, that was buoyed by a stronger share of small business owners saying they expect sales to improve over the next quarter. That's a really good sign as small business owners, when the survey was taken going into the holiday season, whether it's Small Business Saturday, Black Friday, Cyber Monday. And so, moving into the holiday season, they seem fairly optimistic, more optimistic about sales moving forward. And so economic conditions seem to be fairly supportive for small business owners. And they are telling us that, so far going into the last part of 2025, that they're doing pretty well.
Yeah, certainly. We know that this year has been really rocky for corporations of all sizes, especially those small business owners. I have to imagine that one of the headwinds has been, of course, hiring. And you think about labor markets, as you point out in your research, most labor market metrics did improve in November. How is that filtering through to these small businesses?
Yes, labor market constraints are a huge issue for a lot of small business owners. Right now, if you look at labor quality and labor costs as the biggest problem facing small business owners, about just under a third, about 30% are saying that one of the two are their single biggest issue in operating their business, which is constraining their ability to take advantage of sales opportunities if they're not able to fill those open positions, fulfill those hiring plans that they may have for the next quarter. And so that's putting a lot of strain on businesses, certainly in specific industry sectors, namely construction. So that's limiting their capacity to grow their business. But they're still expecting strong sales in the next quarter, and that was a good sign. So the labor market is still being very supported by the small business sector.
I am curious just about what you're hearing from some of these businesses with regards to their ability to handle any sort of potential shock to the economy. And I bring that up because the CFO of JP Morgan, Marianne Lake, she was speaking at a conference earlier today. And I'm just going to read exactly what she said. She basically said that consumers and specifically small businesses, in her words, look healthy, but that the environment that they see is a little bit more fragile and that there's less capacity to weather incremental stress, end quote.
So we see that our uncertainty index is still at very high levels, historically speaking. So small business owners, understand that, and they are concerned about what economic conditions look like going forward. We've seen very low, kind of capital investments in small business owners, so they're holding on to a lot of cash as much as they can. Earnings have eroded a bit because of those higher costs related to supplies or inventories. But even, as far as having to increase compensation to retain their current staff and also insurance increase premiums. So, all of that's contributing to many of these factors. But the uncertainty element of it is of concern for small business owners. They've had to pivot and transition over the last number of years. And so, they're trying to set themselves up for success if they have to do that again.
All right, Holly, I have to leave it there. Always appreciate you coming by, adding some great context here to that report that came out earlier this morning from the NFIB. Holly Waite is the executive director of the NFIB Research Center. A closer look at the state of small business. When we come back, we're going to talk about the state of animal health care, a conversation up ahead with Jeff Simmons. He's the president and CEO of Elanco, and they're fresh off the heels of the company's first investor day in 5 years. We're going to talk to him about his strategy for the company moving forward. That's coming up next here on The Close. This is Bloomberg.
The structural fundamentals that really drive the growth is more and more people adopting pets, more and more people wanting to spend more on those pets, and those pets aging. And that's not just in the U.S. and in developed markets. We're seeing similar growth rates in pet care across the globe.
And that was Zoetis CEO Kristen Peck telling us last week that global growth in pet care is fueling her animal health business. Let's dig deeper into the space with a direct competitor, Elanco Animal Health Jeff Simmons. He is the president and CEO of Elanco. He joins us live on the heels of his company's first investor day in 5 years. Jeff, great to see you in set.
Great to be here. Thank you. Yeah, it's been an exciting day.
Yeah, I would imagine so. I was taking a look at your share performance year to date. You're up about 69% on a total return basis. So 2025 has certainly been kind to you. How do you keep the momentum that you're seeing in the business going in 2026?
Yeah, first I would start with the space. Okay, the space overall, we've got a $40 billion industry, pets and protein, the farm animal side, and we're expecting about 20 billion of growth actually over the next 10 years. And a lot of that's because of these trends, the healthier eating habits, coming back to animal protein, the humanization of pets. For us, what's really driven this performance this year is growth, innovation, and cash. The quality of our growth continues. Today, we outlined a new financial profile for the next 3 years. Mid-single digit top line, high single digit EBITDA, low double digit EPS, really fueled by an innovation growth that we've not seen in our 70-year company history. Elanco's 70 years, longest standing animal health brand here in the U.S., and we see tremendous innovation. We've got a basket of 6 innovations right now that we're launching. That was a lot of the discussion at the innovation conference. We opened the door to share 5 to 6 more coming between 2026 and 2030.
Well, tell us a little bit more about what you've shared so far and what innovation means in the context of your company.
Yeah, so first of all, on the pet side, I mean, there continues to be not just the humanization of pets, but that's globalizing as well. I think you're seeing the international markets grow very well. What Elanco has that's unique is we've got a lot of innovation in the biggest markets, and these innovations are differentiated. So the tick, flea, heartworm marketplace, $6 billion for the dog and cat market. We've got the best medicine going into that. Credelio Quattro. That's taking significant share. It's the fastest blockbuster we've ever had in our history. The next market, a $2 billion, the itching dog derm market, and that market is growing double digit. We've got new medicine there, and we announced today that we're in the administrative review on our second product going into that market. So look, major markets, differentiated innovation, taking market share, and getting market growth.
Do you have more pricing power on the pet side or on the farm veterinary side?
Yeah, great question. On the pet side, definitely. There's more pricing power. I would say more durable probably over on the farm animal and just overall growth. It's maybe more low to mid-single digit growth, but we've really seen this protein, this movement back to meat, milk, egg, fish, the healthy eating habits, even GLP use. is driving more animal protein use. So we see it especially in beef and poultry.
How does, though, the increase, the inflation that we've seen in some of those things, you mentioned eggs, obviously beef prices have been up, chicken has kind of oscillated a little bit as well. When you have prices like that spike at the wholesale and the consumer level, does that affect your business?
You know, much less so. I mean, I've been in this industry for 30 years. We've seen almost 30 consecutive years of growth in this industry because of the durability of some of the trends of pet and livestock. Also, Elanco offers a wide portfolio. We're in and outside the vet clinic. Right. We do the OTC as well, so we can reach really any pet owner where they want to shop at the price point they want to shop at. That's unique about Elanco.
Well, I'm sorry, but not about the pet. I mean, specifically on the farm side of the business and the idea of these animals being for consumption, and the idea that right now a lot of people going to the grocery stores, going to the restaurants are seeing higher prices there. Does that curb appetite, pun intended, for that stuff, and does that affect your business?
Right. It actually, we have a direct positive impact on that. So the whole idea is, even with the cattle shortage here, we've got a new blockbuster in that cattle market that actually can help farmers. Healthier animals are more productive animals. That creates a more cost competitive value proposition. So actually, we play well in this economic proposition and been doing it for a lot of years.
Well, like you said, when it comes to the livestock side of the business, that tends to be more durable. But you think about farmers, plenty of headwinds over the past couple of years when it comes to farmer income. You mentioned, of course, the cattle shortage. I'm wondering whether that has shown up at all when it comes to veterinary visits and how much farmers are willing to invest in medicines for some of these animals.
Yeah, we've just come off from probably the strongest farm animal business in the U.S. that we've had maybe in 10 years. And a lot of it is this. We've got winning portfolios in really the three big spaces. When you look at cattle, dairy and beef, swine and poultry, we're number one in those categories. But it's bringing innovation in, helping farmers. What do farmers want? They want disease prevention, but they also want the productivity, and they want to give consumers what they want, which is more affordable. So I think our portfolios have put us in a pretty strong position. Innovation matters in this industry, both on the pet side and the farm side. I think the excitement about today was we showed the most robust pipeline maybe of any company. And we've never in the history of any time in 70 years had 6 major blockbusters we're launching now, with 5 to 6 more coming. We announced those 6 blockbusters. We will see them more than double between now and 2028, which will be probably the biggest catalyst of our growth.
Does that increase your market share in those areas?
It does. Yeah. So, existing wide portfolios, one innovation will actually help grow the share, both in a vet clinic as well as on a farm operation.
And Jeff, you've mentioned a few times the protein craze that is underway in the United States right now. I don't know where it started, but it feels like everything has protein in it now. What does that mean for you for 2026 and beyond? Has that factored into your outlook at all? How does it actually touch your business?
Yeah, it's 50% of Elanco overall. We're leaders, and again, as I said, in cattle, poultry, and swine. And it absolutely is. I said, hey, compared to the investor conference 5 years ago when people were talking about, hey, a meatless Monday or something, it has shifted back in a big way as, hey, this is taste, cost, nutrition has put protein back. So there's major investment right now in dairy and in beef as well as in poultry, and it's globalizing. American farmers are the most competitive, so this is a net exporting business, and the durability of, animal agriculture is still pretty strong.
All right, Jeff, really appreciate it. Jeff Simmons, President and CEO of Elanco Animal Health. Katie?
All right, let's take a quick look at how markets closed on this day. And honestly, there's not much to talk about. This pre-Fed Tuesday volume was lower than usual, but we're taking a look at some specific names here after hours. Cracker Barrel, I see they're up there on the board, down about 11%. We know that they, of course, reported some pretty tough comp sales. Some other names in the red as well.
GameStop,
I can say your eyes are better than mine.
Well, my glasses are better than yours.
Yeah,
I think my eyes are a lot worse than yours, but GameStop, Dave & Buster's, as well as Casey's General Stores. Of course, GameStop, Dave & Buster's out with earnings, not really giving anything upbeat.
No, certainly not. This is the close on Bloomberg.
We like to have a menu, and I think it allows you to indulge in the people that you love And if you got to buy a teacher gift this holiday season, if you got to buy a Secret Santa gift this holiday season, maybe you're a little bit more price conscious. And this is a place you can come to that satisfies more of your everyday needs. We're looking to be that neighborhood store, the place that you think of that is really convenient, but also has special things that you can buy for the people you love.
The CEO of Macy's Inc., Tony Spring, telling me just yesterday that he's looking to provide a wider range of offerings for his consumers, everyday consumers in his words, specifically at physical Macy's locations. And that is a big sort of a driver of this particular holiday season, the importance for brick and mortar stores to take on the role of brand ambassador for when consumers experience online shopping fatigue. Joining us to talk a little bit more about that is Oliver Wright. He's the global consumer lead over at Accenture. And Oliver, I do want to start there with the physicality, because we had a colleague of yours on from one of your competing companies, and they had some great data about this holiday shopping season. And it was about the foot traffic in various malls across the United States and how that foot traffic was up. More or less, we were looking at 6 to 10% increases in foot traffic in some of these malls, which seemed to belie a lot of the gloom and doom that we talk about when we talk about brick and mortar retail. Give me a sense, put it in context here. Are people actually gravitating in a meaningful way back to brick and mortar?
There's definitely a strong interest in getting back to stores this year. And part of that is driven by consumers really wanting to be very price sensitive. So they're definitely looking for those value deals. But also we're seeing a number of people who want to really latch onto the holiday experience and to make sure that they can resolve some of the kind of decision fatigue that they're seeing, to really make sure that what they're buying is really something that the people they care about are really, really want. But one thing that we're also seeing in the data is the degree to which people are also looking at indulgence for themselves. So one of the big shifts that we've seen is historically, if you think about the biggest kind of single chunk of spending was on kids. This year we've seen a split where we're now seeing the strongest category is actually people looking to shop for themselves and for their immediate partners or spouses. And obviously for that, getting into the store and really having that experience is something that people are really looking forward to.
With regards to just the entire sort of shopping experience, I mean, where does that start? Are people still starting that process online and then going into the store, or do they go first to the store, maybe see what's out there, maybe go back online to double check prices and then go back? What's the trajectory?
Yeah, so I mean, the biggest single change we've seen this year, and you'll probably have heard about this from others, is the use of AI in this process. So we're now seeing that 8 in 10 consumers are actually looking at using AI in some way, shape, or form. And that's basically breaking out into 3 pieces. So there's the question, the biggest actually single one is people still looking very much for value and price to understand when those opportunities are. But then also a lot of focus on the opportunities for what the product is that they should be looking for. So for reviews and really making sure they can use Gen AI to cut through a lot of the clutter. But then also vitally, I'm looking for where they should buy as well. So those 3 elements of price and value, obviously, the product itself, and then obviously the location. All of those now are increasingly starting through tools like Gen AI.
Oliver, it's interesting to have these 2 parallel trends. People are returning to store, looking forward to that in-person experience, at the same time tapping more of these AI tools, because at first glance, it could feel like those 2 things are in conflict.
Yeah, and it's actually, interesting enough, it's not an either or. So one of the things that we also do is we do surveys that actually look at how workers in store are looking at this. And almost half of them are now starting to see shoppers actively using Gen AI tools in the store to enhance those insights that they're getting in the shopping experience. So it's definitely not an either or. We're increasingly seeing this very much as a hybrid experience.
A hybrid experience. I want to talk a little bit more, and you touched on it, and how sort of stores are using it. I'm taking a look at your notes. You talk about frontline retail burnout. I have to imagine that the holiday season only exacerbates that. What is the potential for AI to sort of help some of that burnout that we do experience?
Yeah, I mean, I think one thing I would say, and again in the data, is definitely one of the big messages is please spare a thought for those retail employees, because 70% of them are looking at burnout even before the holiday season has started. And the biggest single driver of that won't surprise people. It's actually dealing with angry and impatient customers. So please do be sympathetic. But what we're finding is that consumers are basically looking at using both in-app stores, so things that retailers are looking to create, but also more general tools. So, the eponymous ChatGPT as an example. Both things are getting increasingly used to help that shopper experience.
So it gets to this idea, Oliver, when we talk about the trends of the holiday shopping season, do those trends carry over into the non-holiday season?
Yes. I mean, I think we are fully expecting to see the use of Gen AI as a tool becoming more and more and more pronounced. What we're finding is that the big power that we're seeing from this is the emotional resonance that the tools have and the degree to which it is very much localized to that individual. If we look at two different profiles of the way in which these tools are being used, the feedback that it gives to the user are very, very different. So if the two of you, for example, put exactly the same question into ChatGPT, the responses back to you would be very, very different, both in terms of what it would recommend to each of you for the same query, but also the language and tone that it would use for you as well. And that's really endearing the tool to consumers.
I am curious, Oliver, about what you know about the pricing side of these AI tools. There's a great story out there floating around today about the dynamic pricing that Instacart, the grocery store delivery service, has used. The idea that if I go on to buy eggs and Katie Greifeld goes on at the same time, she might see a completely different price than what I see. Are you seeing more experimentation of these AI and technology tools by retailers to adjust pricing based on whoever the consumer is?
Yeah, I mean, I think the idea by retailers as a whole is to make this experience as personalized as possible to that individual consumer, to make it as relevant as possible. But one of those messages also be the degree to which value is playing an integral part in the design. So we do definitely expect there to be a stronger focus on that sort of price discrimination coming through, but also the way in which value for the product and for the deal is actually being expressed in a way that that particular consumer can better understand. And again, that's why this is being called the most human technology that we have seen.
I do want to talk a little bit more about the health of the consumer, because heading into the Thanksgiving holiday and, of course, the Black Friday period, there was a lot of conversation that if you think about some of the discounts that are being offered, that people are using that, shoppers are using those discounts to basically stock up on household items. It's not necessarily holiday shopping. Holiday just pertains to the period. Oliver, I'm wondering if you're seeing any evidence of that type of behavior as we continue to talk about just stubborn inflation.
Yeah, I mean, I think the value message and the hunt for value, the hunt for price is a very, very dominant piece of this. And just remember, when I look at these different ways in which Gen AI, for example, is being used as a tool, the number one driver above anything else is those looking for those price and value opportunities. Is the price going to fall at the retailer that I'm looking to shop for? Or is there a better deal around? So that's definitely something that's there. And we fully expect that sort of price consciousness and the use of Gen AI to drive that as a permanent feature. The trends that I'm describing, we only see as getting stronger and stronger through the Christmas season and beyond.
All right, Oliver, great to get some time with you. Really appreciate it. That is Oliver Wright. He is Senior Managing Director and Global Lead of Consumer Industries over at Accenture. Now, still ahead on the close, what investors need to watch over the next 24 hours. This is Bloomberg. Stocks finishing the day just about flat as we are less than 24 hours away from the Fed's final interest rate decision of 2025. Here to help preview what's to come is Anna Wong. She is Chief U.S. Economist for Bloomberg Economics. Anna, it seems like the consensus is that, okay, we're going to get a rate cut tomorrow. That is pretty much a lock. What type of performance are we going to get from the Fed chair, though, in trying to message what the central bank delivered?
Yeah, so I think Jay Powell will struggle between two roles. The first role is to be a consensus builder, to acknowledge the views of the more hawkish majority in the FOMC, and to say that to help telegraph their message, which is that they don't want any more cuts. They want a shallower path of cuts, perhaps that there should be only zeroed or another 25 bips of cuts. The second role he's trying to play is to reflect his own true beliefs, and our team's view is that Powell do believe that the economy can get more cuts because he does put a lot of weight on the beige book. And the beige book suggests that the labor market is quite weak and will need some more cuts.
So, Anna, I mean, why should, if at all, the market even care about this idea of dissent? I mean, I know we've had a pretty long track record, at least in modern history, of these decisions being relatively unanimous. Why does that matter?
Well, it's unanimous only in appearance, and when you actually read the historical transcripts in the past 20 years, it actually, the internal disagreement oftentimes is more elevated than what it seems. So with tomorrow, I think we are going to see only one open dissent, but there will be at least 5 silent dissent. And when the transcripts come out 5 years later, we'll see that, in fact, there's like tremendous dissent, like it did in the 1990s.
Yeah, absolutely. It's going to be interesting to get those minutes when they do drop. But Anna, you think about 2026. We know the Trump administration wants to appoint a new Fed chief that will be sympathetic to their urge to have lower interest rates, whether it's Kevin Hassett or someone else, TBD on that point. Do you think that the economy will be in a place that will allow for much lower interest rates when you think about that delicate balance between the labor market and inflation?
Katie, I think that's a great question, because I think who the next Fed chair is, that is actually a red herring right now. The real issue is what will the data look like? And our team's call for 2026 is that we'll be seeing a series of very weak non-farm payrolls, monthly readings, at least in the first and second quarter. We also do not expect to see inflation flare up in the first half. So basically, we think that right now the markets are penciling in another 50 basis point of cuts next year. That's too few, and that sometime in the first half of next year there might be some repricing for more rate cuts, given how the data will look then.
All right, Anna Wong, chief economist, U.S. economist for Bloomberg Economics. A closer look here at the big Fed decision scheduled for tomorrow. Of course, we will have full coverage of that. And we point out, Katie, it's this idea, obviously, the 25 basis point cut, a little bit less of an issue than actually what that debate is behind the scenes. But also this idea of what exactly is Powell doing for the next, 5.5, 6 months? If we're calling him a lame duck, if he's not going to be able to usher consensus here, then who really is actually driving this conversation?
Yeah, and as we were just reminded, it's not one person. You have 12 people in the room that all have to make a decision. So it's going to be interesting, of course, to hear from the Fed chair tomorrow at 2:30. We do also have earnings to chew on, starting with Chewy dropping their quarterly report before the market opens.
All right, we're also going to get earnings, of course, from the AI space. Look for those reports after the bell. Full coverage right here on the close of Oracle, Adobe, and Synopsys. And just a reminder, our coverage of the big Fed decision actually starts at 1:30 p.m. Eastern Time, where Team Surveillance will be picking up the mantle for that 2 p.m. announcement.
Yeah, looking forward to see the reaction, of course, to the 2 p.m. drop, and then the reaction to what we actually hear from Powell himself.
Also keeping an eye on the CEO of Microsoft, Satya Nadella, scheduled to go to India through December 12th. This is Bloomberg.